What is going on, investors? The Creative Investor here. Now, in today's video, we're going to talk about how to trade options for beginners, literally from scratch. If you do not know what an option is or how to trade them, but you have heard about them and heard of gains that you can make with them, this is your video. Now, that's what we're going to break down in this video. There's a lot of different strategies, but I think I'm just going to break down the basics of what an option is, how to trade an option, and all that good stuff. So if that's the kind of content you're looking for out of a YouTube channel, then hit the like button and subscribe. You are at the right channel. I'm going to go out on a limb here and say that most of you guys are probably going to start with Robinhood. And Robinhood is probably the easiest brokerage to start trading options with. It's not the best for experience. I'm talking like a couple years experience. It's not the best, but to start off, it's very good, and I use them. You can see I have quite a bit of options, and I have my own strategy, which I'll get into in this video or a different video, but the main point is how to trade options for beginners. So if we're gonna look at a company, and let's just do AMD, because I like how their options work. So it's a little bit different on desktop how to get to the options, but it'll be right here, trade AMD options. If you're on mobile, it will be in the same button as the buy or sell. It'll just say trade options instead of buy or sell. It'll say trade options. So you go to trade AMD options. So the most important thing is the expiration date. So generally, the longer the time you pick, the better, because essentially that gives you more time for your stock to move up or down, depending if you get a call, meaning you want the stock to go up, you're calling on it to go up, or you're betting on it, you're putting down a bet for the company to go down. So that's the most important thing, is picking the strike you want. Now, there's a lot of different strategies, like if there's a news event coming up or earnings, then you're generally going to pay more for contracts, and that is called premium. So let's just say generally I like leaps that are a very long time, but I'm just going to use like the Aprils for you guys, because I wouldn't recommend getting anything shorter than an April right now, because that's only 2 months away. So we're just going to look at calls. So you're calling on the stock to go up, right? And just for the meaning's sake, when I say premium, I mean the price you're paying. Now, when it says 0.88 cents, it looks like it's less than $1, right? But it's times 100. So really, this is $88, this is 116, this is 155, 223, 310. You get it. It's times 100. So just look at it like, switch the decimal place around. So it's 88.0, you know. I hope that makes sense to you guys. That's really the only way to explain it. So let's take the 120 for 88 cents, right? So essentially, if you bought this for 88 cents, you're saying you think AMD will go to $120 by April 16th. Now, if you buy this, it will cost you $88, assuming you get filled right away. Max cost $88. So the most you can lose is $88 if you're buying a call. Don't sell. Don't even worry about selling a call. Forget the sell button is here. Just don't even look at it. It's bad news unless you know what you're doing. So buy, call, and you buy this $88 right? So you think AMD is going to go to $120. If you want to get technical, you're spending $88, and it does say right here, your break even. On mobile, it says this too, but desktop, it's right here. Your break even, $120.88 to break even, to gain what you're spending on the contract. So it's basically, you need an option to go in the money. You need it to go in the money to make money. So don't just buy any option because the stock's going up. You really have to calculate where you think the company will go. And a lot of that goes down to companies that you follow, companies that you know how they move. I know how AMD moves. It goes up a couple dollars for a couple days at a time. It might go up $5 a couple days at a time, $1 or $2 every day. Or it could also do the same going down. So I know how AMD moves, so I personally wouldn't buy this contract. It doesn't make sense to me. That's moving $33 from its current price just to break even. So I'm just going to stick to calls too. But what I have been doing personally is going out to January 21st, 2022 to, let's say, anything under $1,000 I really like 115 bucks. I think AMD will be well over $115 by next year, January 21st of next year. So you'd look, right, if you were buying this 115 call, it would cost $938. And then Robinhood just does it really easy for you. So the $938, $9.38 plus 115 would be $124.38. So essentially, you would need AMD to be above $124.38 by next January to make any money. Now, anything over that, for every dollar, you essentially control 100 shares without owning them. This is the most important thing to realize. So anything past your break even, let's say this goes to $125.38. You're $1 in the money. You just made $100, just like that. Now, if this goes to 150, right? Let's just say 150, simple math. 25 bucks, that's $2,500 you just made. And if it goes higher, then more. But you do have a time premium, which the time premium is the amount you're paying. So you would have essentially more than $100 per dollar move. Like, the contract would be worth more than that if it was in the money right now, because people are expecting AMD to move up. And it's the same way with puts, and I really don't want to get too complex on you guys. I really just want you guys to get a feel of it, because essentially you guys will have to do your own digging and learning. I don't care what YouTube video you're watching, anything you're watching, you have to do this stuff to understand it. But you really should understand what you're doing before you try it. Where you can paper trade, that's a really good option too. I think E-Trade, like Thinkorswim, has paper trading. Webull has paper trading, and you can do all this stuff with fake money to get a feel for how it works. I wouldn't recommend buying anything until you know how it works. So the same principles apply with calls and puts. So it's still controlling 100 shares without actually owning 100 shares. The only difference is you are betting that it goes down. You're putting down basically money. You're putting down a bet that it will go down. So essentially, you'd want to do this only on a company you thought was going down. So I don't necessarily think AMD is going to go down at all, but I mean, if you had a position and you wanted to protect it, that's more or less what I use puts for. But if, let's say, you thought it was going to go down by 50%, you thought it was going to go down to $43, 44 bucks, whatever, then it would be justifiable to buy this $55 put for next year, so it won't expire for a year. And so your break even would be $52.02, and you'd spend $298. Whoa, oh, what did I do? No, so you'd spend $298, you'd buy one, boom, you'd buy it. And I always recommend to really read this section, because this will literally just tell you exactly what it says. It says you're paying $298 for the right to sell 100 shares of AMD for $55 per share by January 21st, 2022. So if you have the right to sell these shares at $55, you would want the stock to be well under $55 to make money. Because if you were selling the shares for 55 bucks and they were worth 65, why would anybody buy them? You know, why would you sell them for 55 bucks? It wouldn't make sense. So if AMD shares aren't $55 or lower on January 21st, 2022, this option will expire worthless. So that is the biggest thing to understand, is if these options don't move to your strike price, at least to your strike price, then they will expire worthless. That's not to say you can't lose if they go to your strike price, because you have to factor in what you paid, and that is where you get your break even. So anything under $52.02, you would make money. So if it went to $51.02, you would make $100, because that's factoring in the 55 strike price, which is where you get in the money with $298 of what you paid, your break even. So anything under that, you would make money. So I'm really trying to say this in the simplest terms possible, but for beginners starting with options, I would paper trade. Now, if you don't feel like paper trading for whatever reason and you have a larger amount of capital, then I would only buy leaps, which is contracts with a year or more of time, which these are leaps to me because we're so early into the year, or even the June 17th ones are good too. Because you want as much time as possible, because if AMD were to go up 10%, you would make considerable amounts. You probably make 20-30% on your leaps, right? If AMD went down 10%, you might lose 10% on your leaps. So for me, it's a great risk to reward value, because essentially, even with all these leaps that I have, like some of my big ones, Big Commerce, which this isn't even really a leap, but it's $150 call on Big Commerce, and that's $83 currently. I spent $1,080 when Big Commerce was about $90. It fell since then. Last trading day, it was down 5.29%. This Big Commerce was right here. You see that? And I only lost 8.98%. So almost 9%. So you don't risk as much because you have time, and time is factored into all these contracts. That's called the IV, the implied volatility. That's where you get a lot of your gains that aren't in the money. Like if you buy a call and it goes up because the stock went up, then that is implied volatility is going up. More people think it will move up. Now, even if you buy a call or a put and it goes up in value from the price you bought it at, essentially it has no value. It has time value, but it doesn't actually have value, because an option derives value from a stock. So if it is not above or below your strike price, for a call it would be above your strike price, for a put it would be below your strike price, then that would essentially still be worthless until it got in the money. That's where you really start to get dollar for dollar and start to make impressive gains, especially if you buy out the money calls or puts and they go in the money. Then you're basically hit the lottery, which is pretty cool. Doesn't happen all the time. With the leaps, it has been happening more so this year. But I think that's all I got for you guys as far as just the basics of options and what is options and how to trade them. So if you guys got any value out of this video, hit the like button and subscribe for me. It really helps to push this video out to more people. And hit me down below in the comments if you trade options. I would really like to hear from you guys. I respond to everybody's comments, so I appreciate that, guys, and I'll see you in the next video. Peace out.